In this video, we will look at the top indicator that you should be looking at if you want to know where mortgage rates might be headed. Hi, my name is Mac Rogers. I'm a real estate broker here in the Bay Area. Welcome to the channel. Mortgage rates have increased significantly since the beginning of the year. Each Thursday, Freddie Mac releases its primary mortgage market survey. According to the latest survey, the average 30-year fixed rate mortgage has risen from 3.22% at the start of the year to 3.55% as of last week. This is important to note because any increase in mortgage rates changes what a purchaser can afford. To give you an idea how rising mortgage rates impact your purchasing power, check out this graph that I have here. So how can you know where mortgage rates might be headed? While it's always difficult to know exactly where mortgage rates will go, a great indicator of where they may be heading is by looking at the 50-year history of the 10-year treasury yield and then following its path. Understanding the mechanics of the yield isn't as important as knowing that there's a correlation between how it moves and how mortgage rates follow. Here's a graph showing the relationship over the last 50 years. This correlation has continued into the new year. The treasury yield has started to climb and that's driven rates up. As of last Thursday, the yield was 1.81%. That's 1.74% below the mortgage rate reported that same day, and is very close to the average spread we see between the two numbers. So the next question you should be asking is, where will the treasury yield head in the future? With this information in mind, a 10-year treasury yield forecast would be a good indicator of where mortgage rates may be headed. The Wall Street Journal just surveyed a panel of 75 academic, business, and financial economists, asking them to forecast the treasury yield over the next few years. The consensus was that the experts project the treasury yield will climb to 2.84% by the end of 2024. Based on the 50-year history of following this yield, that would likely put mortgage rates at about 4.5% in 3 years. While the correlation between the 30-year fixed mortgage rate and the 10-year treasury yield is clear in the data shown here for the past 50 years, it shouldn't be used as an exact indicator. They're both hard to forecast, especially in this unprecedented economic time driven by a global pandemic. Yet understanding the relationship can help you get an idea of where rates might be going. It appears based on the information we have now that mortgage rates will continue to increase over the next few years. If that's the case, your best bet may be to purchase a home sooner rather than later if you're able. The bottom line, forecasting mortgage rates is very difficult. As Mark Fleming, chief economist at First American, once said, "You know, the policy of economic forecasting is don't ever try to forecast interest rates and, or more specifically, if you're a real estate economist, mortgage rates, because you will always invariably be wrong," unquote. However, if you're either a first-time home buyer or a current homeowner thinking of moving into a home that better fits your changing needs, understanding what's happening with the 10-year treasury yield and mortgage rates can help you make an informed decision on the timing of your purchase. Hey, thanks for watching. Please click the like button. It helps our channel a lot. Have a great day.